Financial markets face several risks over the next few months. First, the Fed may start tapering its quantitative easing this year rather than waiting until 2022. The Fed's July meeting minutes indicated it could start cutting its bond buying in 2021 if the US economy keeps recovering from the pandemic. Slower asset purchases by the Fed may cause renewed volatility in asset prices. But we expect there is much less risk now that the financial markets will suffer another taper tantrum as occurred in 2013. The Fed is likely to wait until as late as its November meeting before announcing that it will begin reducing its bond buying. The central bank is also likely to only slowly lower its asset purchases at subsequent meetings, so that it only finishes printing money in late 2022. Risk assets are thus likely to continue benefiting from the Fed, only gradually tapering its quantitative easing over the next few quarters. The second risk to the outlook is the increasing spread of the Delta variant globally. The new virus strain is especially threatening to emerging economies where weaker healthcare systems are struggling to deal with surging infections. But the major economies, with their faster pace of vaccinations and stronger budgetary resources, appear more resilient to the Delta variant. The new virus strain seems to be only denting rather than derailing their recoveries from the pandemic. For example, August purchasing manager indices fell in the US, the UK and the Eurozone, but they still remain in clear expansionary territory. The third risk to consider is the recent softness of China's economic data releases. July's exports, credit growth, fixed asset investment, retail sales and industrial production were all weaker than expected. We have trimmed our 2021 forecast for China's GDP growth from 8.7% to 8.2% after July's data releases. But we expect vaccinations in China and increased local government borrowing to finance infrastructure spending should help activity rebound later this year. Thus, while financial markets face several threats over the next few months, we expect the global recovery will continue to defy the risks. The major central banks will keep setting very low interest rates, and governments will provide further fiscal aid to enable economic activity to continue rebounding. We therefore see the macroeconomic outlook continue to favour risk assets this year. For more information, please read the latest edition of our monthly investment guide titled A Season for Doves.